Hey folks, welcome to Market Technical Analysis by InTheMoneyStocks.com for Tuesday, December 11th, 2007. Well, the market's been closed for about 15 minutes as I start this report. It's about 4:15 p.m. Eastern Time here in New York, and what do you say but wow. This is why I go into Fed meetings basically all in cash, give or take a couple small cap, small positions, because otherwise it's just ludicrous. And in general, it's too much to risk. I'd rather buy after the meeting and I see what the move is and then make the decision again. When it comes to the day trading chat, that was what we advised in the day trading chat. Don't be in a day trade going into this meeting. Be very cautious, mostly in cash, and that was the right move 100 times over. Once you saw the initial move, some people in the chat room jumped on the short side and made it bundles. You know, also other people jumped on the long side of QYD, which is 2 times short the NASDAQ, and made a nice chunk of change there too. MasterCard was shorted. There were a few other plays that were just beautifully done by some individuals in the chat room, and I must take my hat off to them. They continue to impress me with their expertise and their knowledge as they continue to learn from the chat room and to take other people's opinions and ideas and make them their own and mold them into some successful traders. And I have to say, it's been a great asset to have them in there for InTheMoneyStocks.com, myself, and I think they find it a huge asset as well. So I encourage everyone to come join us. It's fun, it's entertaining, and hopefully you make some money too. In regards to the market, the Fed, this is what we talked about yesterday, folks. When all is said and done, it's what the Fed was going to do. We said the market could rally or could fall. That's the question. What does it do? And the big thing was, well, what does the Fed do? Does the Fed cut by 25 basis points? Well, that's what they did, but they also cut the discount rate by 25 basis points, but that wasn't enough. We had talked yesterday how the bond market was pricing in 25 basis point cut, and usually the bond market tells the truth. All right, the media hypes different things, but the bond market tells the truth, and that's what we saw today. And I'm going to put up the ES daily chart pattern so you can kind of see, well, the intraday first, and you can see what happened here. I mean, look at this drop. Just a ridiculous drop. But long story short, the bond market was right on here. We basically knew they were going to do a discount rate cut as well. It was just a matter of how much. The market wanted 50 basis points, probably in both, although they probably would have been okay with a 50 Fed funds and a 50 discount, 25 discount rate, or vice versa, a 25 basis point cut in the Fed funds and a 50 basis point cut in the discount rate. But that's not what the Fed gave out. And it's funny, you know, in the chat room, we were joking around, was Cramer going to jump off the handle again and go crazy? And right away when he came on, they actually played part of his little nutty spiel and yelling sequence from when he really went off the wall a while back. And he basically said he bashed the Fed. No doubt about it. He bashed the Fed. And he said, hey, there's no even point to get mad at it anymore. He's like, you know, the time to do anything was a while ago anyways. They didn't act aggressively enough, and he bashed them. So those of you that, I'm sure you can find that video on YouTube. It's nothing crazy. He didn't yell or anything, but you know, it was just interesting to hear him talk. And I happen to agree. Us here at InTheMoneyStocks.com, we're realists. We understand the markets. We're economists. We understand that what's going on now can't be prevented by rate cuts now. And that's important for everyone to understand. And I'm going to throw up the NASDAQ chart while we're talking about this. And you can see the drop, and I'm going to put up the daily, and it's just an ugly, ugly chart on the daily. But discount or rate cuts take 6 to 12 months to filter into the economy. So anything we're going through now, or even in the next 6 months, is not going to be helped. So that's the important thing to understand too. So I feel like the Fed in many ways is worried about inflation. If they cut now, it's only going to help the mental side of the market, not the realist, not the economy itself. For quite a while, and then by that point in 6 to 12 months, is inflation super high, and do we have hyperinflation because of too many massive rate cuts? And I think that's, those of you that really understand the markets know that oil has been climbing, mostly on the dollar declining, which is inflationary as well. When you have all these commodity prices and things are made, everything, most plastics, most everything has oil in it, or some offshoot of oil. So you're going to have inflation coming through at some point. It's just a matter of when. And I think it's naive for people on the street to, just because the markets are, you know, continually flying higher and they want that to continue, to not realize that, well, look on the horizon. What's coming? Do we want to be prepared for that? Because I got to be honest, you know, if you let this kind of stuff filter through, and if it does, yes, we're probably going to see a recession. We've been saying that at InTheMoneyStocks.com for 6 to 12 months now. that we were going to see a recession. We were called heretics. We were called, people wanted to burn us at the stake when we were calling this out 6 months ago, and the market was rising insane amounts. But we were right on, and it looks like it finally, the media and the government are beginning to say what we've been saying for a while. So go figure, you know. It's nice to be proven right, I guess, you know, but it's not a healthy thing for the economy. We don't hope it happens. We just call it like we see it, how the charts and technicals tell us. Now, anyways, let's look into what happened with this market, all right? The NASDAQ got crushed today, and here's the NASDAQ, down 66.6 points, or 2.5%. The S&P was down 2.5%, or 38 points, and the Dow dropped 300 points, or 2.14%. Just an ugly day across the board, folks, and what do you say here? But look, you can see right here, and I'm going to put something up here for you guys to see. Okay, folks, and if you can see here, I just added in the 50 moving average, and look at how perfect this was. It's almost too perfect to set up. And what I want to show you here is, here's the 50 moving average. Look at what resistance we were facing today with the Fed, and how perfectly this moved. Alright, so you basically have us hitting that 50 moving average, and then the Fed comes out and we drop. And it almost looks too perfect on the chart. But what you have to understand now is that we're facing the downside, and probably going to have to hit this 20 moving average on the downside. So keep in mind, this is looking at the moving averages, the technicals, the chart patterns. And now the question is, was this the MA pattern? And we're going to have to look at this now, because look at this M. We talked about this M for tons of videos. And the question was this the A, and this the completion of the A pattern? Or was, and let me just take this away here so we can actually do it appropriately. Alright. Or was this the M, and now this is the A pattern? Okay? And now does that mean we drop like this? Alright, so this is going to be the big question, because it's just a matter of what was the formation. And when you're looking at a chart pattern, sometimes you can be a little iffy and you're not 100% sure till we confirm it. Now, a confirmation would be a breakdown right here, pretty much. You take out that low, and then you, alright, well, that was the MA pattern, and so forth. But MAs are notoriously bearish chart patterns. Now, the question remains for me is, there's a couple different things I want to point out on this chart. So let's take a look. Number one, you have a gap window here. Those of you that know gaps, and gaps are very important to know that this is support. So see where this little line right here is. This is dramatic support here. We just basically touched it today. Now, the question is, if we close below this on the daily, then you're going to probably have a gap fill, or you'll have an intraday gap fill, even possibly tomorrow should we go lower at this point, and this gap will be filled on the chart. Now, if that happens, we're basically going to the 20 moving average. And once we get to that 20 moving average, then we look for support, alright? First hit on the downside off the 20 after we move back through, usually you get a small bounce. Should we not get that bounce and we close lower, well, then you have a new gap window, folks. And that gap window is right here. And if we, well, that'll be the next point. So first of all, you have 1 point here of support on the NASDAQ at this gap. Then you have number 2, which is at the 20, which is at the filling of the gap right here. Then number 3 is this point right here at the next gap window fill, or gap window, excuse me, not the fill yet. Should we take that out, and then we hit the 200. Okay, and that will be the next level of support on that fill of that gap. And you can see the gap right here in between, okay? And that'll be the interesting portion here. And we'll see where we go from there. Let me just remove that so you can see them. So number 1, support here. Number 2, the fill of the gap and the 20 moving average. Number 3, the gap window here. Number 4 would be the filling of that gap and the 200 moving average. So on the NASDAQ, that's what you're looking at on the downside. Okay, and it's important to realize. Now on the upside, we could easily have a move back up. Let's say they come out tonight and reread this statement by the Fed and the market says, okay, it's not that bad. Well, on the upside, you got right back to the 50 moving average. No doubt about that, folks. I mean, that's on the upside. So, you know, weird situation. Now, I don't think that's going to happen, to be honest. I don't think that we're really going to get crushed, although I could be wrong here, but I don't think we're going to get crushed into December here, right? Bonuses, it's bonus time. There's a lot of incentive for the market to hold up here, okay? So keep that in mind. So yes, do I think we might test the 200? Yeah. But do I think we're going to break this point, which is dramatic? We break this point, and it's all bets are off on the downside. We drop here. You know, we're going down to the lows down in this area right down here, should we take that out. So I don't think that happens before January, but in themoney.stocks.com, we've been talking about that happening for a possibility after this bounce into Christmas. So keep that in mind, folks. Okay? So again, that's the way it looks. Now intraday, I've spent a lot of time talking about here, but now you got to assume for tomorrow, folks, China, India, Hong Kong, Japan, they're probably going to get hit tonight, okay? So you got to expect that as long as they don't reread this statement and no new information comes out, we'll probably gap down. Now, whether or not we bounce after that is another story. But look at this dramatic fall when the Fed came out. I mean, you did not have much of a bounce. You had a small bounce here maybe, but overall just a huge fall. You're talking about a huge fall in the NASDAQ from 2730 plus, from 2734 to 2650. That's a big fall and very dramatic. Now, just quickly, we got to end this video here as I got to do some odds and ends here and look for swing trade alerts for the swing trade alerts and more action for tomorrow. But here's the SPY. We closed below the 50, below the 200 moving average and the 50 today. Next support on the SPY would be right here at the 20 moving average. But again, you have a gap window fill right here, a gap window right here that's going to give support. All right, folks, have a wonderful day. Stay tuned. Tomorrow's going to be wild. Take care.